Tom Lee went on CNBC today, and the headline of this clip says stocks are set up to perform well over the medium term, says Fundstrat's Tom Lee. Now, honestly, when I was listening to this in my car just about an hour and a half or so ago, I was stunned at a couple different moments during this clip. And I think it's something that's worth highlighting. Anytime Tom Lee speaks, it's really something worth highlighting. This guy is from Michigan, just like myself. Maybe that's why I'm so fond of Tom Lee, but we do disagree from time to time. And I do have my own critiques, and that's what's great about finance YouTube, or what's great about Wall Street in general. People do not have to disagree to, respect someone's opinion. Yes, Tom Lee is correct a lot of the time, and he will be correct again. I mean, medium to long term, you don't want to bet against the U.S. economy. In the very near term, actually, Tom Lee thinks we could see downside for markets. And that was one of the stunning parts of this clip as well, if you will. So go ahead and listen to this clip. I'm actually going to stop the clip periodically to kind of break down some thoughts that I had. And we'll do that here in this video as well.
Bull market story still intact, as Wall Street has largely avoided the seasonal weakness, as we were mentioning, of August and September, but a number of threats are looming, including, of course, the election 4 weeks away. Our next guest is looking past the headwinds and focusing on three tailwinds, including a dovish Fed, China's late stimulus push, and lots of cash on the sidelines. Let's bring in first CNBC contributor Tom Lee, co-founder and head of research with Fundstrat, and our very own Mike Santoli joining us as well. Tom, let me start with you. It was in April on this program that you said you thought the S&P 500 could close at 5,700, maybe even higher. Well, looky here. Look where it is today, right about 5,700. So the maybe higher part is still a part of your formula?
Yes, I think it's part of the formula because, bull markets are supported by strong fundamentals. And this is a case where not only has the economy survived extremely high interest rates, but the Fed is beginning to cut rates. And an economy that has sort of been languishing has been China. And now we have some stimulus and what looks like some bazooka policies that is supporting that region. And we have a lot of cash on the sidelines. So I think that this is a formula for stocks to do pretty well the next 3 to 12 months. And that's why we think that we would be well beyond 5,700 before year end.
Well, so Mike, Tom says tailwinds overpower headwinds here.
Yes, although I think you do have some offsets. And I think that even though the August and September, the advertised seasonal weakness didn't really show up in the terms of sustained downside, it did become a less rewarding market, right? You had more downside moves from that August 1st level than you had upside, at least during those 2 months. So I do think that reflects the fact that we have priced in a pretty decent scenario here. We're 21 times forward earnings on the S&P 500. I think a soft landing is pretty much what's underpinning that idea. That said, it's hard for the market to get into too much trouble when the Fed is easing into a resilient economy. And even though we're having to worry about maybe less Fed easing than we thought Thursday before we got this jobs report, I think that's a better formula. Economy holds up better. The only reason you'd worry about it is if you think the strong Friday jobs number was a head fake. And all of a sudden, it really was not representative of the economy being strong, and yet yields are higher, and yet oil's higher. We're benefiting from those things starting at very low points, under $70 crude, and then, 3.6 on the 10-year as a low recently. And so, therefore, the big violent vertical moves we've had in those areas have not really upended anything except maybe the housing stocks. But I do think, you have to be aware that we're 2 years into a bull market. That's often where it kind of flattens out and becomes a little bit less aggressive on the upside.
Okay, now I have to say, when I heard that, I was like, holy shit. Nobody has even acknowledged that is a possibility, that the August jobs report was just a head fake, that the economy is maybe not as strong as we think. After all, let's consider this. There was nothing that suggested to us the August non-farm payrolls report was going to be a 253,000 number. Okay, ISM services employment, ISM services manufacturing employment, your beige book, company earnings, they've all been bad or just not suggestive of a super strong economic backdrop. But yet non-farm payrolls came in with this huge number. And yes, when you looked under the surface of non-farm payrolls, what really caused them to be so strong was over 750,000 government jobs that were created. Now, it's tricky here, okay? Because did we really add 750,000 government jobs, or did teachers just go back to work? Now, yes, these were teachers that went back to work, which makes sense if we think about this in retrospect, because August is when school starts generally for most school districts. So that had a outsized effect on the jobs report. So that really got me thinking, like, maybe the next couple of months could look worse to the downside. And I think that's worth at least considering at this point. Now, I think Mike Santoli there also made a very great point that if this is a head fake with, let's say, the next non-farm payrolls report that we do get, we may get that report and now 10-year treasury yields are 4.5%. Maybe Q3 earnings are just okay, or maybe not the greatest, at least from FedEx, Nike, Levi's, Costco. Most of those earnings, Darden restaurants, most of the early reporters that we've seen so far have actually had bad things to say. They really haven't been the greatest earnings. Even companies that, we had higher hopes for, like Costco, just barely met expectations pretty much across the board. Like it wasn't that exciting for even Costco, which was one of the better reports. Micron has also reported so far. They had the best earnings report, but even Micron's earnings still had holes you could poke in them. Okay, now most of the time company earnings are not perfect. Most companies have holes to pick in them, but specifically with FedEx, and this is something that I'll probably always remember, the day after the Fed cut rates 50 basis points, they cut rates on September 18th, was September 19th, and FedEx reported earnings, and the CEO of FedEx said, I quote, "The magnitude of the Fed rate cut yesterday signifies the weakness in the current environment," end quote. I mean, Wall Street didn't even pay attention to that, but that was like a slap in the face to me. Like, what? How can FedEx, a company that is about as cyclically tied to the economy as possible, say that, and Wall Street didn't pay attention to it? Like, that to me is crazy. Neither here or there. A couple of weeks have passed by, and we got this jobs report. 10-year treasury yields are rising, oil's rising. When we get the next jobs report, if it is not showing this robust employment market, yes, it's going to be after the election. And what I've said for a while now is I'm really not concerned about the economic data from now until the election. So we'll get another non-farm payrolls report coming out in a few weeks, let's say. Might be right before the election, actually, when we get the next non-farms. We'll have to double check that, but it's going to be right around that time. We could walk into that with these unfavorable conditions, and then Wall Street's going to say, basically overnight, like, did we do too much damage because we've had 2 months of rising treasury yields restricting the economy even more after it was maybe not as strong as we thought? Maybe the markets in turn, off of like 1 month, fluke labor report just restricted the economy too much. And maybe there's been too much damage done. And I think Q3 earnings will really hold the largest weight to markets. As I said in prior videos, I think it's really Q3 earnings at the top of the list. That is the thing that is going to make or break our markets more than anything else. Although you have actually seen earnings estimates really come down a lot heading into this earnings season. Technology and industrials, believe it or not, have seen their estimates fall the most. So like a lot of your big tech stocks, their estimates have actually been coming down. So typically when that happens, it's easier to beat and stocks tend to go up more. But it's pretty unusual to see earnings estimates fall for companies heading into earnings and the stocks not fall. Like that's pretty unusual. Okay. Next up, in terms of an order of magnitude of importance, is economic data. Although earnings and economic data are kind of tied hand in hand with each other. Third up is geopolitical tensions. Last is the election. Okay, I really don't think the election is a downside catalyst nor an upside catalyst at this point in any kind of material way because of the uncertainty around the economy, because of Q3 earnings season, and the potential uncertainty around that. Not to mention geopolitical tensions. I don't think the election is really a big deal at this point. Thus, that's where I kind of disagree with Tom Lee's call for this huge rally to year end. A lot of it has to do with what we normally see after elections. And I think this year is just so unique that we can't really copy and paste prior election years or cycles and say, the same thing's going to repeat this time. I think that's kind of a flawed mentality view of what challenges we face in the markets relative to other election cycles. Other election cycles, we have not had these kind of challenges. The last time we've had these kind of these challenges during election years, really with downside economic activity, the risk being not the economy accelerates, but it decelerates, was 2008. And in October, just this week in October, the same week, markets fell almost 20% in a week. Okay. So yeah, I just think copying, pasting what happened in other years just isn't going to work as well for this year. Now, again, with that said, I don't have all the answers. These are just my thoughts, my opinions. I've been kind of weary of this market for a while, and who knows, could be wrong. Things could be great, and next month's jobs report may just be a stellar. But again, in retrospect, looking back, it makes sense why the government payrolls came in at 750,000 jobs, right? It was teachers. Now, how is that going to hold up in the next couple of months? I think you kind of got to revert back to ISM manufacturing employment, services employment, some of your challenger job quits that were just brutally terrible. I mean, the ADP employment change was the worst on record in September, obviously not factoring in teachers, right? So some of these things are worth considering. Like, was this just a one-off strong jobs report like we have seen in prior years? Right before recessions, you tend to get really strong jobs reports. And is this a head fake? Definitely worth considering and diving into that a little bit more, as we will do here on this channel over the next coming weeks for certain. But let's continue on with this clip.
Said the third year is the hardest one often.
Has tended to be, yeah.
Tom, do you want to build on that and address what you should do with small caps here, why they've been so, actually that's probably the one area we've seen the most weakness since the Fed hiked rates.
Yeah, small caps, they're within a few percentage points of an all-time high, and Mark Newton, our head of technical strategy, thinks we are still in an up move for small caps that just started recently, but yes, it's been disappointing. I think it's been especially disappointing because China and small caps historically are fairly highly correlated. And so we are seeing risk on appetite increasing in some places. But I think it's just a matter of time. I think part of this is, between now and the next month, which is around election day, there's a lot for investors to digest. It's including oil prices, and the VIX is elevated. I think these are things that are hard for someone to say today, between now and early November, I want to be buying risk outright. So I think small caps still have good fundamentals. Earnings growth is accelerating. The median PE is 11 times, which is almost 7 turns lower than the S&P. So I think there's still the case to be made that small caps are starting a multi-year gain. It's just been very choppy.
As you look at oil, what would an interruption of Iranian oil supplies, which is really only 3%, as I understand it, of global output, what would an interruption of Iranian oil mean? Maybe not in economic terms, because it might not mean very much, but what it could mean psychologically to the market.
Well, markets don't like uncertainty, and oil is spiking not because of demand, but because of like what you're pointing out, Tyler, the risk of a disruption. And oil can move up quite a lot before it actually triggers the level of burden that causes a recession. That number is probably closer to $200 today, but it would be no fun for any consumer to see oil at 120 and gas prices more than double. So it's something that I think would be very painful for consumers just to see oil surge, and even if it's temporary.
Yikes. And I was kind of surprised to hear Tom Lee have that perspective on the oil markets as well. For someone that tends to be as bullish as Tom Lee is, we are in agreement that a spike in oil, even temporarily, would be a major problem for the economy. Like, especially with the holiday season, that would not be ideal, okay? Would not be ideal at all to see. I mean, even to see the kind of oil spike that we had just, in 2022, like, let alone going higher than that, would be a major problem for the consumer, which the consumer is already not in a great place. That would be the catalyst that would push us into a recession. And, when I jot out the list of catalysts for markets of magnitude of importance, again, where I said Q3 earnings, then you have economic data, then you have Israel-Iran geopolitical conflicts, I only put that third on the list because I don't think we're going to get some kind of targeting of Iranian oil. So if we don't get that with Israel's retaliation, then you may see oil go up a little bit, but it's not going to be this huge problem for markets. And I genuinely think we're not going to get that. Now, having a small hedge on oil could make sense because oil's cheap. And I personally do have a small hedge on oil for the upside, because if I'm wrong, well, that could make a lot of money. That could protect the portfolio, right? There's definitely advantages being long oil right now in the event that does happen. But do I think it's going to happen? No. If it does happen, then I'm really underplaying how big of a catalyst that would be. Like, I don't think you guys understand. That would guarantee a recession at this point. It would, not just the amount of money it would cost families. We're talking hundreds of millions of dollars a day in additional cost for collectively, right, for the entire U.S. population. But it psychologically changes the way that people spend money. Gas prices going up dramatically, and to potentially what could be multi-year highs, changes the way people shop on Amazon. It changes the way people shop at Walmart. It changes the things that people buy. So it's not just the cost itself. Psychologically, gas prices have a major effect on spending habits. That, I think, is an even bigger issue than gas prices going up a couple dollars a gallon. It's the psychological aspect that is really dangerous when it comes to spikes in oil markets. And we've already started to see that. Could it go more? It probably will. Is it a big spike? Do we wake up, is oil up 20%? Like, that would be a major, major problem. So it was reassuring to hear Tom Lee talk about that at least a little bit here in this clip as well. Thought you guys should hear it. Hit that like button as well as subscribe to the channel. Let me know what you think about this latest commentary from Tom Lee down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.